Welcome to CEO Insights. We have with us today the CEO for Bandhan Asset Management Company, Mr. Vishal Kapoor. Vishal has more than 2 decades plus of experience from various organizations, Standard Chartered, Amex. He has also been an industry veteran. He is a director with FPSB, which is Financial Planning Standard Boards of India, and has also contributed in a major way to developments with respect to AMFI and other boards. So let me welcome Mr. Vishal Kapoor for our CEO Insights chapter. So I would rather start and take his time for some key important issues or key important queries that we face on ground with the clients and with the RMs also. To start with, let's start about the global scenario, and especially on the bond side as well. Now that Indian bonds are obviously in the global indexes, and how do you see that as one of the changes, and how do you see the global economic or global geopolitical situation unfolding?
Thanks, and really a pleasure to be on the show. It's a pleasure to engage with your team as well as your clients. Just on the first question that you had on the global economy. One shouldn't believe that the coast is all clear now as yet, because I think we should brace for the fact that global economies are largely slowing down. Some of the excesses during the COVID phase, where a lot of balance sheet expansion happened across a lot of large economies, that is still in the system. And that over the last few years, as many will know, has led to high inflation, that high inflation being combated with high interest rates, which central banks have had to actually get into, which means there's some amount of stress in the system in terms of earnings as well as balance sheets. Now, the best case, and you can only assign probabilities to this because there's no absolute outcome that one can forecast, but the best case or the most probable outcome that we are forecasting right now is that it'll be a soft landing, which means that, as the Fed has also flagged off, that this should be near the peak of the Fed rate hike cycle, which means things should ideally start getting better from here, not worse, in terms of interest rates at least. So if you're a borrower, it should not pinch you more going forward. We must recognize, though, that rate resets happen with a lag. So sometimes when interest rates go up, as a borrower, my interest cost may not go up immediately because I may have had, especially in the US, a slab-based system. So essentially the pain of higher interest rates may not be fully out there as yet, and therefore one has to basically be holding on and making sure that there's no credit event that happens. But given the fact that the Fed is now feeling that rates should be near peak, we should be a lot more confident about the direction of the rates, and therefore the fact that things should cool off in terms of inflation, rates should come back, and therefore if we can get through this phase without any major adverse impact, then it's as good an outcome as we can imagine. Since at that stage, which may still be maybe 6 to 9 months down the road, you would feel a lot more comfortable about where macro is heading at a global level. Eurozone may be slightly different. China is again a large player and obviously slightly different. But if we were to group all developed markets together, one would start to believe that 3 to 6 months or later, once the rate decline or the reduction cycle hopefully starts kicking off, that would be a good signal to say that central bankers now feel a lot more comfortable about cooling off of inflation, and therefore the worst hopefully should be behind us.
That brings me to the other part of the equation, which is rate cuts. Everybody has been anticipating rate cuts, I think, since December onwards. Some part of the rally also happened because of the anticipation of rate cuts. However, the inflation and the other numbers have been moderating, and there have been positive signs on the otherwise not so urgent scenario to do a rate cut, and that's what is the overall consensus is, that probably the rate cuts is going to be shifted to maybe the second half of this year, or maybe slightly lower, slightly even to the fag end. How do you see that as an impact on the bond market per se?
So I think the good news is that the market consensus, and this is especially true after the Fed flagging of the near peak, of the US rate hike cycle. Because as we've been sort of commenting as well, that it's very difficult to see how the RBI will get into a change in stance and start cutting rates without being reasonably clear and sure about what's happening to the global cycle. Because the RBI cannot act in complete isolation to what's happening in the rest of the world, right? But once you have a situation where the Fed and some other central bankers think that this is near peak, it does give you a lot more confidence about the direction of future interest rates, which is it should be now going down. Right? Now, when it happens is of course subject to so many factors, but I guess the market would believe that sometime later half of this calendar year is probably a good time for that to happen, because that's based on how the Fed is flagged off when it may look at its own cutting cycle. So I think it'll be surprising to see RBI take any definitive action without first being sure about how the developed world is looking at rate cuts. Once that cycle starts off, I think RBI may feel a lot more confident, a lot more comfortable in certain ways, because the Indian macro is a completely different story. The Indian macro is definitely looking a lot better, but you can't be isolated from what's happening in the rest of the globe. So therefore, I think RBI may look to see how Fed and developed market, Eurozone, etc. is behaving on interest rates cut, and then be able to take some more definitive steps in the latter half of this year.
China and Japan, your views on them?
So I think the growth in China is obviously not measuring up to what at some level for emerging markets one would have hoped. So clearly that looks like going to impact therefore global growth. Now that has obviously one impact in terms of emerging market and global growth slowing down, because China is clearly not doing as well as one would have hoped or imagined. On the other side, if you look at it from an India standpoint positively, then commodity price risks therefore get lowered. Because if a large consumer of commodities like China is not going to grow as fast, then to that extent, commodity shocks or anything that fuels inflation, that may be a risk that is much lower now. As opposed to the situation where, let's say, China was growing very rapidly, then you would have some amount of inflationary pressure as well, because commodities would generally be a lot more stronger. On Japan, I think, again, we're not expecting as much growth, but essentially what's the stance on interest rates? And, it's also a big supplier of capital. So to that extent, of course, Japan is very important from many standpoints, but it's difficult to see how it would be a huge growth driver for the rest of the world. So, like we were saying earlier, I think we have to brace for 2024 being a slow year in terms of global growth. And let's hope that there are no major blowouts anywhere. And once we get past that phase, because the bulk of the interest rate related pains should hopefully be out of the system, I think then 25, 26 onwards becomes the more interesting story.
The China plus one story. So how do you see that unfolding in India? So
in theory, it is definitely there. But I would say, why only think about it as China plus one? India has done so well in services over the last, 2 decades plus. And I think that's been an absolutely outstanding outcome for GDP growth.
Yes.
Because, with agri generally not being the growth engine for an economy, services has clearly done a fabulous job over the last 2 decades. And therefore, you're asking the question that why not manufacturing?
Yes.
And, with this entire push on Make in India, PLI, etc., lower corporate taxes, a lot of infrastructure investments, and now going out aggressively to say, look, come make in India. That itself is almost like a thing to be done. And it's good to see that that's happening. Now, it happens to also coincide with a phase where China is slowing down and some amount of geopolitical and concentration risks have been brought to fore because of COVID. So therefore, the willingness of a lot of global manufacturers or multinationals to shift or diversify their manufacturing just presents an additional opportunity. So from that standpoint, I think it'll be great to see a lot of manufacturing actually get established in India. It's definitely beginning to happen. But the scale and size of it is something that we have to really focus on and see, which are the industries and which are the sectors in which we are really able to get to the mammoth scale that China has built. We remain very, very bullish on the fact that manufacturing should become
the next growth engine.
An additional growth engine, because services again
Services
are great, and services are done very well. It's actually done better than consensus in that sense, despite its very high performance over the last many years. But if manufacturing can actually add on, clearly the opportunity is there, then it makes the India macro story even more aggressive in that sense.
That brings me to the segmentation of the market, which is about the small cap and the mid caps. Views on the mid cap and small cap. They already had a decent rally. And where do you see that now?
Investing into small and mid cap, you're an equity investor, then please don't be trading, invest. And if you're investing, I would say take at least a 5-year, if not a 7 or 10 year or a even longer term view, right? So you're looking at this decade at a minimum, right? Now, in this decade, given everything around us, right, which is that there is clear traction in manufacturing, a lot of infrastructure has been built, which is now almost waiting to be used. Whether it's roads, ports, freight corridors, etc., right, airports. So a lot of investment, which has largely been government capex led, has now been put in place. It's almost crying out for private sector to join in and jump onto the manufacturing bandwagon. There have been reasons why this has not happened over the last 5-6 years, but this looks like the ripe opportunity for us to actually see the upside from that side, right? So if growth is happening, I would argue, why would you be so worried about just the near-term returns? Yes, the near-term returns have been quite spectacular. You should not come in because one part of the market has delivered 50, 60, 70% return, and that's what you expect. That is being just naive about this. So therefore, if you stick to a broad allocation, I would say please don't exclude mid and small cap even today, because fundamental factors, structural factors that have benefited small and mid caps do continue to give you reason to say that this growth can actually sustain for at least a few more years.
PSUs as a sector had a very, very good run so far. Do you really think the valuations are perfect, or are we slightly ahead of our time?
You've seen a lot of sector rotation over the last few years, and many of these have been very quick and sharp. And something that was left behind for many years, where there has been a structural story, there has been a lot of clean out, and it has been again core industries coming to the fore because of, again, a lot of this growth and a lot of the capex that will be required to build into this, the few of the themes that we mentioned. And therefore, many of these being in the PSU domain, that should benefit. So therefore, the investors figuring out that, look, if these 4 or 5 themes are what you want to bet for, bet towards, then if PSUs are well placed and they're not very expensive, then why leave them out, right? But over a very long period of time, I think the market will also reward efficiency, efficiency of capital, efficiency of being able to compete, etc. So to that extent, historically, over very long periods of time, have PSUs been able to beat other sectors of the market? That is something you just have to be cautious. So if you're playing a cycle, then it really is a bit of, do you have the ability to get in and get out with the cycle? But if you're playing a theme, then is this the theme that you think will outperform other themes is really the question. And that I would say you have to be a bit more cautious about.
So BFSI as an index hasn't done so well post-COVID. What is your view on the same?
No, so definitely I would say, like I spoke about earlier, see, with the theme of financialization generally getting embedded, so let's look at India. About, if I'm not mistaken, about 2 decades back, only a third of our household savings would go into financial assets. Right? The 2/3 was going into real assets, either gold or real estate, etc. Right? Today, more than the majority of our assets, 50% plus, is going into financial assets. Right? So Is financialization a theme that is reasonably embedded? I would say yes. Right? If you do look at the new age resource, people coming into the workforce now, are they behaving in a manner which is a lot more formal as part of the economy, and therefore banking from day one, investing from day one, etc.? The answer is yes. Right? So the structural upside is definitely there. Then it becomes a question of, in the valuation cycle, how is BFSI relative to something else? So I think this is maybe a bit more of the cyclical valuation and relative valuation story than a structural story. Structurally, I would think BFSI will still be a very strong contributor to economic growth. Where you want to get into the cycle and how you want to actually participate may be different. Now, banks is clearly the dominant sector. Banks had the benefit when, in that sense, where you have NIM expansion as interest rates go up. Now, as interest rates come to a peak, people may be a bit worried about NIM expansion not being as much of a real opportunity. But then this is typically the phase when CapEx, the private CapEx cycle starts. So that's when your loan books start getting built. Loan books getting built over some period of time will obviously then lead to NIM expansion again. So part of that may be just part of where you are in the cycle for NBFCs, for banks and NBFCs. Other parts of the BFSI world, wealth management, insurance, etc., it can be impacted by some amount of immediate margin change or regulatory changes, etc. But structurally, you would want to believe that these will still be high growth areas for some time.
Erstwhile IDFC and now Bandhan also is actually known for its debt and bond management, and also obviously has been doing pretty good on the arbitrage side as well. Where do you see the liquidity situation in India right now, and how do you see the bond market situation?
I think the bond or the fixed income area is, frankly, from where we sit today, looks very exciting, and I hope that a lot of serious investors don't miss it out. Because as in, to our mind, this may be the time when you have to take a very serious look at your fixed income portfolio. Now, as an investor, therefore, when interest rates go up, most advisors will tell you that you don't want to suffer mark-to-market risk, and therefore keep it in the short end or keep it in fixed income instruments which are guaranteed, like a fixed deposit as an example, right? So you know how much interest you're going to get. So large part of the fund world or the investing world is actually in very, very short duration products. If you look at the shape of most books, between 6 months to 2.5 years is where most of the duration of customers' portfolios would probably lie, right? Or even shorter.
Even shorter, yeah.
But now, if you believe that interest rates have hit a near peak, then the situation going forward may be completely different. Because when the reverse of this happens, whenever it happens, right, you can actually benefit from mark-to-market gains. And that's the reverse of what you may have suffered in the past. So it's actually maybe, the peak of the cycle is the time to now be a lot more bold and at least be more careful, considerate about what is the duration of your portfolio. And in our view, this may be the time to actually start extending it to whatever is your risk appetite. Right? So our response has been that in our actively managed products, we have extended duration quite significantly. So as an example, our dynamic bond fund, which is an actively managed duration, strategy, the maturity is north of 25 years. The modified duration is in the 10.5, 11 year.
Very nice, very nice. I think you're the only asset management company that probably has done that kind of a shift.
Yeah. So as we speak, we have a dynamic bond fund which has got a very long, average maturity. We've got a gilt fund, the investment plan, which again has a very high, average maturity. Our NFO of the long bond fund, which is what we just launched, is similarly.
It's again duration call.
It's a duration call. So there are choices that we are offering to many investors based on the risk appetite to actually use to extend the duration. Just recognizing that it's not necessary for all your money to be in 25 years. Right? Even if you want to move from, let's say, 2 years to 3 years, right? and you don't want to obviously liquidate your entire portfolio and move to a new product. But if you take 10% of your money and buy a 11-year mod duration product, you are actually extending your duration by almost a year. So it's a very easy way for you to actually achieve your duration target by using some of these funds.
Vishal, as investors, there is one debate that is going on in the mind of the investors also, that passives have been doing well. So it is active versus passive. That is a question that everybody is asking. That is there value addition into active management?
Right. So passive have been doing well because the markets have been doing well. So because the passives are largely going to be a function of the market. But if you look at the last cycle, clearly active funds have outperformed across many parts of the market, not just in small caps or mid caps, but across the market, you do see a lot of outperformance. So yes, one can understand the argument from one group of investors who will say, and there's a school of thought which says, look, if I can't control the fund manager choice and the ability of that fund manager or house to deliver alpha, let me at least control what I can, which is the fee I pay. So a low cost product which is mirroring or mimicking the market at least gives me market returns, and I at least save costs. Nothing wrong in that argument, has been done and proven across many developed markets. And there is one very large group of investors who would want to progress in that manner. Right? But the flip side of the argument that in emerging markets, are there opportunities outside of the broad indices that fund managers are able to capture? I would want to believe at least the last rally seems to have demonstrated that the answer is yes. There are significant opportunities available outside the broad index. Eventually these will get included into the index because as someone moves from a micro cap stock to a small cap and mid cap, it keeps getting included in the respective index, and then that's the nature of the market and the way the index is constructed. But by the time it gets included into the index, a lot of the value has already happened.
Yes.
And that's where the active manager and the ability of the manager to go deeper and pull out some of these companies.
You guys launched a multi-asset fund which had some uniqueness to it, predominantly the international equity piece. How do you see that? So already the NFO is already launched. It's been about 3 months. How do you see that unfolding now?
So we created the fund largely for a domestic Indian investor. Right? For the onshore investor, I guess the point was over there that if you want to have a truly strategic asset allocation model, which a lot of seasoned investors would guide you through, you do need a large part into India equities because that's a growth story and that's a fairly core part of your portfolio. But there is a very strong reason to also have international equities. And the way we've defined the international equities is that there's a 15% allocation as a target in that fund. That 15% will cover the US, developed markets as well as emerging markets. So it's actually giving you a fairly wide global exposure. Now between 50% India and 15% US, you actually get a good 65% equity exposure, diversified across small, mid, large, India, as well as US developed market, as well as emerging market, right? So that's to us a very comprehensive allocation for most onshore customers. Many of these models, of course, will be based on, really stress testing and modeling on past behavior, right? And those tests will show us that over long periods of time, a portfolio like this is a great shock absorber for volatility that may happen in any one part of the market. The remaining 35% largely being in commodities and fixed income is again a great shock absorber for overall equity volatility that you should expect. And therefore, if you don't want to be very active in moving from one fund, one sector, one this, that, etc., and just have a core portfolio, this can be actually a great place to as a great alternative for you to think about.
How do you read the quarter 3 results?
Commentary from the quarterly results often becomes more important, which is what is management, what are industries really thinking about it. That, I think, again, in some of the sectors that we spoke about earlier, that seems to be quite positive. So structurally, do we think that there are any red flags or any excesses? maybe not very major ones. Minor issues will always be there. So structurally, we do think that this is going to be a good phase, both across manufacturing and services. Of course, opportunities and valuations across different sectors, subsectors may be very different. That's the job of the active manager, to try and hunt for these opportunities and get into the portfolio before everyone else does. So that opportunity will continue. Overall, I would be quite pleased with the results.
So this has been an election year. This probably has Indian election, then US elections, and most of the countries will also face some elections this year. Do you see any risk or any opportunities with respect to these events happening around?
So the risk is you wait for election results and you don't invest. So please don't do that. So as an investor, I would say, if there's a way you can just ignore it as an investor, which is if you're thinking long term. Please don't hold your breath saying, I'll wait for pre-election, post-election, this, that, etc. I think it's just going to be...
But surprising, the first study that I got from pre- and post-election rallies were from Bandhan only.
Yeah. So, look, we can study pre- and post-election, behavior. And this is, keep in mind, the context for every election, the context of the economy before the election is going to be very different, right? But this time around, if you're... So, what have we seen over the last couple of elections? We've seen generally there tends to be a rally before the election.
Yes.
So that's a bit of expectation building up, right? And at least in the last, I think, two cases, if I recall correct, post-election also 1 year performance was very strong.
Very, very strong, yes.
Right? So therefore, election years have been good years, right?
Good years.
Because pre-election you made money, post-election also if you held it, there may be election day or week, some amount of seesawing, volatility, etc. But eventually, in the 1 year period post-election, it has been generally quite a good story. Now, whether there is any causality to that or not is the question. So the market seems to have behaved that way. Why exactly is maybe that's the way of the market. But if you're an investor, I would say just if there's a way you can ignore it, stick to your strategic allocation. I think you should do that. If you're waiting for something, I think please relook at your strategy, because what are you waiting for?
So 3 key important pointers that you would want to share with the investors and with the RMs also.
I would say that, if there's a way you can disregard everything I've said, please do so. Because, don't worry about this in a sense. And, what you would want to look at is, if you go back to basics, whether you're an investor or you're an RM, let's appreciate that asset allocation is still extremely important in how your overall outcome will be. And a lot of work and a lot of studies that we've done seems to suggest that we spend 90% of our time discussing sectors, stocks, funds, and things like that, which is all very exciting, which is good. But it wouldn't add up to only 10% of your eventual portfolio performance, right? And we spend hardly any time thinking about allocation. In most cases, we don't even know our allocation. And that study after study has shown is the big decision, and 90% of your outcome will be based on that. So therefore, while the sector and the theme and the near-term movement is great, exciting conversation, it may not matter as much. So go back to basics. First, get your allocation picture in front of you. See if that makes sense. And if you want to change that, change that. And like I suggested, it is likely it's not exactly what you want it to be. So start from there. Right. The second thing, since you asked me for 3, will be that look, this timing the market, waiting for this to happen, that to happen, is just proven time and again to be wrong. Right. So please don't try and do it once again. In pre-election, I'll do this. Post-election, I'll do this. I'll wait for this. I'll wait for RBI to cut, and then I'll decide. The market, looks ahead. And the marketplace is just assume that it's much smarter, and therefore be humble in saying, look, let me not try and beat the market, and try and time it. The age-old saying of spend time in the market rather than time in the market. I think we keep saying it, but
we don't practice.
We may not be practicing it. So let it be for the next 7, 8 years, 10 years, and you'll be, I think, very, very positively surprised by the outcome.
And the third one, sir?
Third one is I would say that it's very human for us to suddenly look at our account statements and be very excited about how much money we've made, and build expectations which are not real. So it's very likely that if you're looking at your account statement, you may have 50, 60, 70, 80, maybe 100% returns over the last year, and 3 years it may be you've really made money and there's a great wealth effect to it, which is fabulous. Enjoy it, right? But if you carry this forward and you start getting disappointed with 15% or 12% returns, then you're likely to make mistakes. So I think it's good to go back to basics and say, look, what did you do this for? And at the end of the day, over long periods of time, if you can beat inflation at an aggregate portfolio level by 200, 300, 400 basis points,
you're doing a good
it's
job.
not an easy thing to do, right? If you can do that, you should be very happy, right? So at times like this, be very mindful about what sort of expectation you're building. Don't be too focused around what's happened. What's happened is great. If you didn't miss it, fabulous. Congratulations. But taking that forward and expecting something, going forward, which is going to be in that range, may lead to disappointment. Right? So, as someone said, happiness is equal to what you get minus what you expected. So if you keep your expectation low and what you get, you're likely to be happier. So stay happy. Our brand tagline is "Badhte Raho," and one of the things we'd like you to do is enjoy the small things in life, because often we can worry about so much about money and financial security that we forget that all of this is a means to an end, which is to live life and have fun. So please, you use some of your gains from the last so many years and have a bit of fun. Spend it, please. It'll help our consumption story, and keep your expectations modest.
That's really nice. Thank you so much, sir, for your time.
Thank
And it's been a pleasure having a chat with you.
Our pleasure.
And we're going to do this
Absolutely.
again 6 months down the line.